Real quick. What do we see? This is oil, CL. Okay, so basically, the day before it looks like it was kind of neutral. Had a drop, it had a pop, and then it kind of fizzled out somewhere in between that range. The overnight was very long. Long inventory. It was bullish, right? Okay, and so that doesn't mean that basically this is kind of neutral. This is long. A lot of profits are made here. Keep in mind. What are we wanting to know? Are we wanting to know that they're going to take profits here? Or are we wanting to know that that they're going to continue this? Okay. So that's what we're looking for in the morning time. And we'll go through the process here of drawing the open swing high and then the open swing low. You know, this looks, no, that's, okay. Okay, so what are we doing here? We're going to mark the top. We're going to mark the bottom. Now, keep in mind that there is an economic report about the, probably about, I didn't keep track of it, probably about oil inventories. It could be about natural gas. I'm not really sure. Sometimes the jobs report can have something to do with this stuff. Sometimes transport stocks, you know, when they report their earnings, sometimes that can have an effect on these prices. Okay, but basically, some of that stuff happens in pre-hours, like the earnings reports, the jobs reports, the stuff that happens that affects the oil market during the session, the regular session, are those inventory reports, the rig count reports, and then any kind of like volatility around maybe the pipelines and so forth. Although in this cycle of the entire oil industry lifetime, including natural gas, okay, there's so much of it now that's accessible due to technologies, okay, and there's so many drillers around the world, you know, regimes and so forth going into the business. And so there's so much of it on the surface of the world, including natural gas, just more of it being burnt off than actually captured and transported, you know, to become of service, that you really can't you really can't get that shocking pop in these markets anymore when there's some volatility or, you know, like some terrorist activity or something, like in the past, the way it was in the past when supply was more limited and demand was, you know, ever increasing. Okay. Now, you have to remember that also technologies are coming along that that threaten this industry, okay, as far as transports and as far as new energy. Okay. Now, keep in mind, I'll just tell you right now, I'm a person that has done some research, and I find that the scientific findings of the 9/11 event and some other events that coincide with some of the things that Tesla has done, not Elon's Tesla, Nikola Tesla, John Hutchinson's research, and HARP, which is basically an EMF station in Alaska with multiple copies of that kind of technology around the world, all combined in with the 9/11 events. where basically buildings turned to dust. 1,400 cars for blocks around were scorched for no apparent reason. The only thing that they were in contact with was papers and dust that had blown through those streets, but people were in those streets. They were in contact with the dust, and they only felt warm dust. They were not scorched or burned in any way or form. They were just covered in dust. And you'd have vehicles that would be basically melted, such as the engine blocks melted, but the rubber tires would be on. You'd have papers everywhere, but for some reason the vehicles were scorched, toasted, and you could even have paper embedded into metal objects, such as the filing cabinets. Now, there was something like 25,000 filing cabinets in those buildings, and they only found one, right? Because the FBI had all of the debris sorted out, all of it. They had this whole area where they took all the debris and they had to sort it all out per what it was, okay? They found one filing cabinet, and it was all mangled, and there was some paper in it. Now, the only way it could have gotten mangled would be like, well, conventionally it was melted. Okay. But there was paper embedded in it, like the files, the thick cardboard files that go in there, right? Those were in there. And they were untouched. They were full color and everything. It wasn't like they were tattered, or it wasn't like they were somewhat burnt or whatever. It was like the color they were when they were up in the building. Right? They even found a parchment of the Bible embedded into some metal. And the papers, now you know how those Bibles, they print in such thin, I mean, it's the most thin papers you've ever seen. Right? Not even tattered, as clear as the day it came out of the press. The ink as clear and readable as the day it came off the press. And this parchment of the Bible embedded into metal. Literally, you can't tear it apart because it's literally embedded into the metal. John Hutchinson in Canada, he has been able to embed wood into metal with the electromagnetic frequencies that he uses to levitate metal, manipulate metal physically, and he uses no heat whatsoever. Okay, so basically what it is it's a matter of manipulating the electrons. I guess not the, well, it might be the electrons, but there's an attraction between atoms. Okay, and so basically what it comes down to is that the attraction between the atoms is manipulated. Therefore, you manipulate the metals. Okay, and including dustifying them, right? Which is what happened to these buildings. Right? That's why there was only, for 110-story buildings, there was only enough debris to fill up about 3/4 of the lobby at the bottom of the building. Right? There just was not, the metal literally turned to dust as it was falling down. Now, I've done the research. I was a big skeptic. Okay, but I've done the research. I've seen all of the claims, all of the videos for myself, all of the pictures for myself. Now, had I not have had basically a 4-year education on the internet, which is basically a university, to be honest with you, which is not politically contrived, you know. I mean, it's just like plain as day, just it's people sharing things you can validate with evidence for yourself. And that's kind of what we do online. And, without that, I I would look at these events on 9/11 and I would have no explanation. I would have no reaction, to be honest with you, because I would not be able to comprehend what happened. It just, I wouldn't have a reaction because I would have nothing to say to it, because I would not know anything about reality that applies to those situations. But when you get down to it, the scientists, when they pick it apart, basically what they come out with is that basically all these things happen because, not because of thermite and not because of planes or fires, but an energy weapon. Okay, and basically, I'm not interested in the whole political side of what that means. I'm more interested in the fact that basically what it means is that there is a fusion kind of energy, or free energy technology out there. Okay. There was the Tianjin chemical plant bombings in China, right? They just exploded out of nowhere, right? And not only that, all the cars and the lots around, they were all scorched as well. I need to do some more research on that, but I suspect it was a similar situation. But those kinds of things threaten the oil and the natural gas markets, as a matter of fact. Fusion definitely does, and I've seen where there are agents that get involved with the scientists that are discovering fusion, and then they throw them under the bus. They get them discredited, and basically they get defunded. They can't get in any groups. They can't get their projects further studied. These experiments require a lot of money. And so if you get disreputized, basically, then you can't get any money in to get your experiments, you know, partaken in, and that kind of thing. So, in respect to this particular market here, basically, if there's any kind of tyrannical nonsense out there, it's not going to shock this oil market anymore. I mean, the reason why is because it's just not as valuable as it once was. It's becoming something like an eyesore. Like, you can't get rid of it. There's so much of it. Right? That's really what it's become. And there's so much money invested in it. There's so many interests and companies invested in it, and politics as well. I mean, you've got, I don't know how many dozen nations in the world. They're tyrannies, but they are almost solely reliant on these carbon fuel sales. Right? That's it. That's all they make, because they're tyrannies. I mean, what else can they do? And so there's so much informational matter of fact related to this particular market and the industry that basically everything I'm telling you is getting swept under the bus. Or not swept under the bus, but under the rug. Okay? So it gets drawn out. But eventually, basically, oil is doomed. It's doomed. Natural gas has more hope than oil. And I keep on saying it, and I've been saying it for the past 2 years. Even before I knew about the energy weapon at 9/11. Oil will be down below $10 a barrel eventually. It'll be in the single digits, and it will never, ever rise above $10 again. I don't know how long. It could be within the decade. Could take 20 years. Okay, but there are not high hopes there. And some people that have researched a lot, they would kind of know where I'm coming from. People that this is new to, it would pay to do a little homework online. I mean, this internet is the new university. 4 years of homework online is going to pay off. All right? So anyway, the thing is here is that we were talking about economic reports. Basically, we've got this. We've got the long inventory. Everybody bought it up, and then we've got the open here. This is kind of a neutral time of day. Not very reliable, I would say, because of the economic report that's coming out right here. And as you can see, the huge quick wick here and the behemoth quick tail down here. So this is just, economic report volatility. This is all very common. And basically this is more impactful than the opening of the U.S. equities, right? U.S. equity index futures. Okay, so I would say basically treat it the same. The first three bars don't really matter much. The first bar, least of all. The second bar, a little bit more. The third bar, a little bit more than that. And then after that, they start talking. They start telling you a story, an investable story. And that's basically how it goes with the U.S. equities as well. Or any market. Basically, when they open up, it's kind of like we're finding out which way are they going to take this thing, and then we'll go from there. So basically, when we do this thing right here, we've got the open swing high, we've got the open swing low, and then we've got two tests right here, and we've got one right here. Now look at this. Okay. What's happening here? Well, we established this open swing low, then it hooks back up. That's why it's the open swing low, because this one hooked back up. We got a bull bar there, and then it came back down. Now, then it head faked through support, and then we got this big quick tail here. Now that is a 10-cent quick tail. It's $100 a contract, so that's decent size right there. Okay, this one is about probably about 80 cents. Okay. Or no, about 8 cents. 8 cents. 8 cents. So that's about $80 a contract right there. Now that's two of them, and this is very unusual. Okay, right. And the reason why, and look, we got a head fake right here as well, right above resistance. So what is all of this, right? This is out of the norm. This is not the usual. These are basically lawbreakers. But in fact, as a matter of fact, if you are fast enough and you are on the ball, right, you are actively watching the trade, right? When this breakout happens, you can grab this trade. When this breakout happens right here and here, even this one right here, that's 4 trades, okay? If you're just looking for 5 ticks a piece, right, that's 4 trades. So count it up, 50 times 4, okay? So that would already make, even though they're head fakes on the oil market, this is pretty good, right? I mean, but that's how it is on the oil market. A lot of times, the volatility on the oil market is a lot more exaggerated, and I noticed that on the 6E euro, big exaggerations, big moves, right? Volatility is just wild. So, and you don't know when it's going to happen, but when it does, it can be pretty profitable. But it's kind of hard to plan for all that, there's a way to trade it. It's a lot of test, trial, and error. You got to have a system for it. I'll probably go across that sometime. So anyway, we've got basically this is like the start of the day again. So this is how it works. Basically, this is the open. Okay, this is the new. Now this is only on days that these reports come out. Okay, so this is the new open swing low. This is the new open swing high. Okay, and all of this, and all of this is scrubbed. All right, that's all gone. Okay, and so we're going up here. We form that. Then we try to get that. We're going to call this some support. Why? Because we come up here, we make a top. come down here, we make a low, and then we get another bull bar. That's why. So basically that's a low right there, right? So therefore that is some support. Okay, and then basically what you're going to do right here is you're going to test. If it breaks out here, you want to trade here. If it breaks out right here, you want to trade right there, and you can get one. Now look, this is basically that's 28 down to 24. That's pretty tight. You'd probably give that one right back. In fact, you might lose on that one, right? Because basically you're going to be 2 ticks below this low right here, and then you only get 2 ticks, and then it flies back up at you, and then you'll be over here. You'll probably lose about 4 to 6 ticks, depends on how you trade it. Could be 8 ticks because, well, no. Oil market, $10 a tick. I would go 6 at most. So you probably lose that one. But stick to the tick, so you put it back on there, right? Because this is still, right, you're still stuck in this range. It's going to break out one way or another. So, and then you catch this one. So basically you make it back. Then you're even right there. Right? And you've got this failure right here. It's not a drastic failure. This did come back up here to make a double top. So now if it would have turned around right there, okay, and it left all these ticks open, then I would say that this is really bearish down here, right? In fact, that is kind of what happened here when it formed a bull bar here. Made it a little over halfway back up to, well, I guess this would be the new support. It's one of the two. I'm not really sure. I mean, you know, nobody can know for sure. This is kind of a derelict little head fake here, a little test lower that failed. Pretty volatile, pretty wild in here. But you've got to understand the mood of the market. You got to be able to basically roll with the punches. It's kind of like if you're on a bull, if you're riding a bull, and you're getting bucked around on there, basically you've got to be able to kind of like go with the flow. You can't just be a stiff board on the thing, okay? You got to be able to read this thing. Okay, it's like that on here as well. You got to be able to read this thing. Where's the greed? Where's the resistance, the block? Where's the disinterest? Okay, where are they stepping out in front really aggressively? Where is nobody actually applying themselves? Where there's no participation, that kind of thing. Okay, you've got to read all that in this. Okay, so get used to it. That's the job. That's really the job. Okay, so then basically you get this. These ticks here didn't fill in, and you got this quick wick right here, which is bearish. So that's all fairly bearish. This was not fairly bearish. Basically, if you put right here to get in, it would have caught you, and then it would have taken your money. Okay, so you would have lost on that one. That's how it goes. Sometimes it costs you. Now, why don't we do something here? Let's see here. Well, maybe next time. That was pretty dumb. Those are my notes. Well, let's do it. All right. So let's see here. Well, if anything will work. There's more information than you need. See if I can get through all this. Yeah, some of this stuff is just notes from playing a video game. I tried playing a video game about a year ago. It's an internet game. It's not really a video game. I think video games are more like where it's a very active, kind of like a... Who would have made something like this? These programmers, I'm telling them. Alright. Well, I guess we'll just have to deal with it. Okay, so... How many trades there? We got 4. Let's see. Let's go with good trades, bad trades. Okay, we had 4. 4 over here. Okay. Got down to here. Made the swing low. Got up to here. That one faked out. That one faked out. Okay, so I'm gonna go 4 good. 2 bad. Right. So far we're 4 good and 2 bad on this. Okay. So you're still positive, and it's just how it's going today. I mean, it's just basically a lot of head fakes here. There's a lot of wicks and tails. That means volatility. That means they're really fighting back and forth, in that they got a lot of orders, and what they're trying to do is they're trying basically to throw it into the faces of any kind of movement. See what happens here if they can wait for price just to break down here, okay, right? Then basically they get down here, and what do they want? They want to buy, right? So they're going to put in a big buy order, okay? And if you're long right here, and then this thing drops below support, and then it hits stops, well, what's going to happen? Their stops get hit, so they're automatically going to sell. So there's some liquidity right there, okay? So they can get these prices lower. So that's why you would wait right there. Then it'll pop, and then wait for it to come back down here. Right? As soon as it crosses the line, start slamming it. Start slamming it with buy orders. Okay, you got liquidity. That's why these things rush up here like this. Okay, then it gets up here, and then somebody's got sell orders, right? So what they're doing is saying, okay, well, we've got we got to get some sells here. So they start dumping out the sell orders. Well, that's fine, because these buyers, they got a bunch of buy orders, and so these things come back down. And then what do? They wait till they get down here, and then slam, right wherever they think that there's some liquidity, okay? Right where people are starting to get itchy and starting to get out of their long orders, right? And it's the same the other way. If sometimes when price is peaking out over resistance, that's when they want to hit you with their sell orders, right? For the exact same reasons. Basically, they know that there's a lot of people right there. There's a lot of activity. Okay, and they're trying to get the best price, and that's why they waited until it crosses these lines. Now, sometimes that's the way it goes. Sometimes, most of the time, everybody is fairly reliable in that they're gonna try to make money on these lines. Okay, it's not a bad business. It's just a matter of knowing how to do business with these things, with these people on here, right? That's what all these lines and all these candlesticks and volume bars and so on and so forth, that's what they all mean. So if you're going with the program, you make a bunch of money. If you're going against the program, you're in an emergency. That's what you're in. You're in an emergency. You basically have a deadline. You got to get stuff done. You don't have all week to get it done. You got all those orders that you got to get in or out of the market or whatever. Okay, so that's a big difference, right? So and basically they could just dump stuff out on the market, which is what happens right here, and it can be done algorithmically, where the computers are doing it, or it can be done manually. But basically, it can be just big dumps, big load dumps, or it can be just making money, right? Rather than any of these head fakes here, okay? These ambushes, okay? They just go along with the program and make some money, in fact. Now I'll tell you what, after I seen all these head fakes over here, and then I saw this head fake right here, and that one right there. Okay, I'm done. I mean, this chart, I'm not a friend of this chart anymore, and it's already 2 hours into the day, into the day after the NYSE opens. That's my frame of reference as far as time goes. So this chart is shot. Okay, So basically on this one, I would be 2-4. 4 wins, 2 losses. Let's see. All right, now here we've got the 6E. It looks like a bearish day the day before, neutral overnight. Looks like some kind of economic report must have hit. Right. So here we go. We've got the open swing high. We've got the open swing low. Then a big cave through. Right. Now, when you've got the this and you've got this, okay. And why is this the open swing high? Because this came down and then it came back up. All right. Now, if it came up and then it was going down and it went down and down and down, right, and it broke through here without going up again, then that would be the open swing low. Okay, because it still would be early enough, right? This isn't really a swing low now, is it, right? So it still has a chance to make that. Okay, basically it's like drawing lines in the sand, or basically drawing the rules. You know, we're gonna get down there, we're gonna get out there on the field, right? Guys is just gonna, okay, you know, we're gonna draw lines here. This is basically where the goals are, whatever. You know, and this is what these things mean. You know the rules. All right, go. That's how it is every single day on these charts. Okay. But this didn't make it all the way down there. It went back up to here. Okay. So this becomes nothing. This is not the open swing low. This is. Okay. It's actually lower than that, right? So anyway, the thing is, though, is that we get a double top here and it fails. Okay, and we're seeing this thing fail. Now, what are you looking for? You're looking for a breakout here or a breakout here. Okay, right? And so you're positioned accordingly. Okay, so you're going to look for a trade here or look for a trade here. Well, that one didn't work out, so obviously you got to be right here. Well, this is easy money, right? So there's one. Let's make that a 5. And we cave in down here. We put in a new low. It looks like you're looking at the MACD here. MACD is turning over. Okay, turning over. So it looks like a reversal. We got the old classic cup right here, and this is a handle, cup and handle. And it's a really good one. It's a really good one. Look at this quick tail. See that? See how it only comes about halfway down to the low here, and then it gets completely rejected. Now look, what's this right here? You ever seen like you ever seen somebody that walked into a lake full of piranhas? Right? What happened? He came back out and he looked like this. Right? Same thing right here. Those are bull pike down there. Okay, and so basically the fishing line comes in, and then bam, they eat that thing right off, right? So then the price reels back up fast, right? It's reeling back. That's what those quick tails are about. And so obviously there's something down here, and that is basically turning over the MACD here. And so basically you get a trade right here. Got a breakout right here. Okay. So look for that one right there. Still got the circle on. Okay, and then basically, oh, we've got a fake out right here. All right, so that's a bad trade right there. Let's see how many ticks that is. Hold on. Yep, that would have got you. That would have got me. So that's a loser right there. And basically that becomes the new line for me. Okay. So that's a loser. That's a winner right there. Let's go ahead and mark those down. Where did my little sticky note thingy here? Let's see here. Good one, a bad one. So 6. Twee. All right. So then you don't ride this whole thing. You just grab some five tick or not fives. I mean this is the 6E. So these are $5 a tick or about $6 a tick. I forget. I know the Nasdaq is 5, so I think these ones are 6 something. Anyway, I'll find out. I just take the profits. Okay. I just look at how much it makes and then I pull the plug. Okay. Now, the thing is though is that once you make 50 or 70 on there per contract, just get out. And if you're a 3-contract combiner for a firm, you shouldn't have on more than 1 contract here. Okay. So just 1. You have to be especially risk adverse, which means that basically you got a low crawl, low size, minimal size, okay, and minimal profits, right? Can't be looking for triple digit profits on these contracts. You just can't look for it. Okay, you got to look for $50, $70, $50, $70, and then go. And don't be afraid to take a loss. I mean, if the thing is not working out and it's only 40, 50, $70, that's a loss. Get out. Just get out. Don't worry about it. You'll make it back, right? The main thing is just not to blow up the account or get locked down, right? Because they got limits on how much you can lose, right? The worst thing that you can do is lose so much that you can't trade and get it back and make some profits, right? You understand? So you want to scratch it as quick as possible. I've heard that in the pits. Now, I've never traded the pits, but I've heard that in the pits, basically the first thing that they make you know, more than anything else, is how to scratch a trade. And the reason why is because people have this kind of intolerance for being wrong. And so when they're wrong, they hold on until they're right. And but what if they're not right? Then they get these big losses, okay? And it's a little bit like being nauseated by a big wave that tackles you and takes you over in the ocean. And it's full of salt and fish slime and whatever, and it's kind of nauseating. But basically, you just gotta swallow it and get through the darn wave, okay? And that's just, it's humiliation. You gotta learn how to handle that stuff to get through this stuff. Because otherwise, these markets will just take you for a ride. Okay? They just will. So you just gotta keep those losses small, and then it's no big deal. It's about as big as your profits. But if you're knowing how to trade like this, you're always gonna have more good trades than bad trades. Okay? And the main thing is to get you through the combine, so you can do even more strategies, right? And then when you can do more strategies, because you're through the combine and you've got 15 contracts of real live money, okay, then you can give yourself a drawdown of $10,000, $20,000, or $100,000 if you want. You just keep the profits on the books, and then you can make your drawdown as much as you want, okay? And then eventually, if you're doing it right, okay, which we will go through, then you can splinter out of that firm and then start your own accounts, and then you've got even more freedom. You can do even more strategies like holding overnight, swing trades, long-term investments, options, different markets, right? You can even get out of the entire Wall Street market, get into other things like tangible businesses around you, real estate, that kind of thing, inventive projects. La-di-da. Okay, but the main thing is though is at this point you are a private. You're not even a private. You are a recruit. Okay, you aren't even a private until you are funded in an account, and that even then is questionable, because if you can't hold on to it, it's because you didn't pass the combine the right way, pretty much. Yeah, and then you earn your way up. Okay. So basically, you've just got to low crawl one contract at a time, $50, $70 a contract. Okay, and that goes for losses too. Right? You get down to $50, $70 a contract for losses, it's time to pull the plug. Now, some traders, what they can do is they can let it take them down, and then they can add a contract. And there's tons of strategies that they can do. Okay, but that's not what I'm teaching a combiner. Okay, because that stuff will get you wiped out. You'll never pass the combine if I start teaching that stuff. That's for when you have like 15 contracts or more. Okay, completely different game. But the thing is, though, is the good thing about it is that you can basically you can make up for your mistakes a lot more often, and therefore eliminate a lot of costs, and therefore that will increase your profits. Also, by the time you get to that phase, you've got enough capital that you don't need as much risk in order to make a really nice living. Whereas when you don't have much capital, you gotta basically low crawl, and you gotta take more risk. You gotta be more active, really. Maybe not as big of risk, but you've got to take risk more often. Okay, and so basically, if you compare the amount of risk that the low crawler is taking compared to the big one, it's a lot more, and it doesn't profit as much. Why? Because if you've got 10,000 contracts, I should say shares, 10,000 shares compared to 100 shares, right? You only need, like one big trade there, right? If it moves $1, okay, it's $100,000 profit, right? Whereas if it moves $1 for the one with 100 shares, it's only $100, right? So therefore, the one with the 100 shares has to take risk a lot more often, more trades more often, okay, which is more work. The one with 100,000 shares doesn't have to take this risk so much. It's a completely different ball game. But I'll tell you what, nobody gets to the big ranker level until they've paid their dues. You've got to pay your dues. And this is not basically you can say it's kind of like a video game, I guess. Existentially, if you want to beat the video game, you've got to learn the risk, right? You've got to learn how to manage the risk. I recommend learning exactly what moods and intentions there are behind these bars and indicators, but I think I've said enough on that. So anyway, this is the 6E, the Euro. Here is another resistance line. This one was real easy. Look how easy this one was, right? Another trade there, another positive trade. One of the things here is that the MACD flipped over to green. That indicates a reversal. Okay, we get back up here to the open swing high, and it fails. Okay, so that's what that test was about, and it failed. And then basically in that time of day where the volume starts to peter off, and it just is not as profitable. The crowd has gone home. So sometimes these things can still rock. You know, the euro can still rock. You can get huge volatility sometimes, but basically the thing is that it's not always there. It's not something that you can really grow to rely on unless you've got nothing else to do. I mean, so at about this time, I'm basically out here. We got that trade right there, a failure here, test right here. I would be waiting for a trade down here. Goes back up, retests. Right? See this thing right here would have had me in there, right? I would have given my money back. All right, so I'm going to add one more good trade here. And, you know, to be honest with you, I am looking for a reason to stay out of these markets. Okay? I don't want to give it back. All right. Let's see. Let's go on to the next market. Trying to do this as fast as possible. I think I will get quicker over time because I won't have to explain as much. Let's see here. Let's do the gold here. Let's back it up. Let's see about overnight inventory. What do we got here? Well, it looks like we've got an obvious reversal down here and a bullish trend. All right. So huge bullish overnight. Okay. That definitely beats out anything that this over here says, which was a big drop off, right? And they are well on their way to 1,300, in fact. And so let's do it like this. So we got an open swing high, and then basically this is the open swing low because this thing did test the open swing high again, and it failed. It left all of this space right here. I know how to mark that. Okay. So basically, okay, see that there, right? All that space right there, those ticks right there, which said that's a bearish indication. It couldn't even make a double top, right? So there's a double top, and then there's a can't even make the double top, which is called a lower high. A lower high indicates bearishness. That basically just means that all of these ticks right here, they couldn't sell. This is like rotting inventory. So if you're long and you see this happening and these things aren't even selling, what do you do as a business person? You try to chuck your inventory out to the highest bidder as fast as possible. And that would be what you would be doing here to get out of your longs. And then you would be looking to get in on the bear side. So you're going to be looking for proof of that. And basically we get down here, we test the open swing low. And Viola, we get a bad trade here. This one is a bad trade. That one would have taken me, how many ticks is that? That is, let's see, 76 to 76 to 2. Looks like 5 ticks. 2 of those would have been where my trigger was, and then 3, yeah, that one would have taken me. So I would have lost 5 ticks on that, and that is a bad one. Even though, look at this, even though we've got bearish signals here, okay, but we've also got to take into account one thing. This overnight, look at all that long inventory, okay, right? Now what happened here? What were we looking for? We were looking for one thing: whether or not this was going to continue or they were going to just take profits, okay? So we're looking for that exact thing. How are they going to react to that overnight? Because we're trying to read minds here. Now we get down here to this meager, tiny, if it even can be called a swing low. That's what that is an open swing low, though. And the thing gets tested, and it fails, right? What's down here? Bull pike. Okay. You know, one thing that I like to do is just wait for this thing to break through here. Break through, and then test up again. Right? And then I'll read how it's going to react below the open swing high or above the open swing, no, the open swing low and above the open swing high. So for instance, if this thing wants to break out above the open swing high, okay, I'll wait for it to break out, and then I'll wait to see how it acts when it comes back down. Does it bounce right on support? Does it turn around even before support? Those are key things that I'm measuring. Okay, I'm trying to see what kind of fish are down there with my fish finder. Right? So I'm watching the patterns. And you can sit here and try to grab the breakout through the open swing high and the open swing low. You can. I'll be honest though, most of the time I'm just waiting for it to go through and then return and form that pattern, right? And form or act it out. How's it going to act out once it breaks through? So that's going to tell me a lot there. So I'll be honest. But anyway, we've got a very long inventory, right? Keep that in mind. So we break through here and it doesn't pass muster, okay? And this thing continues to trend down. Well, what's going on here? They're taking profits is what they're doing, right? They're taking profits, and nobody's interested in buying right here because the thing gapped up overnight. It gapped up overnight, okay? So nobody's interested in taking profits. I mean, nobody's interested in buying right then, right? They're just taking profits. That's what this is, right? Taking profits. Okay, and then it tests again and it fails again. That's it. That gives it away. This sucker is not going to sell off. Once it gets down to here, once it gets down to the open, the market open, they're buying, right? That's where they are. Now, that's got to tell you something. That has to say something to you. Otherwise, you're not doing this business right. Okay, that is your cue. That is like a poker player that has all the chips just showed you his hand. Okay, showed you. Okay, you honestly know how the game can go based on that hand and your hand. All right, so now we go on, and you should be buying. At that point, you should be looking for, basically what you're doing is you're looking for a cue such as this, some kind of resistance here, and then a breakout. There it is. Okay, grab that one and then wait for it to, basically I would do it like this. I'm pretty positive this is going to be a bullish deal here. I would do it like this though. Okay, capture the first bar, it's a breakout. Okay, and then mark the top of that bar. Okay, you're pretty bullish here. Okay, so then you mark the top of the next bar. Now you got another breakout here. How many ticks though? You should be going for five, especially in the gold market because the gold market's not very volatile. Okay, 1278.80 up to 1279.40. That's 6 ticks. Okay, so. And now you get another breakout right here, okay, which is barely anything, and then it almost gives it back to you. Okay, that one is kind of iffy because by the time it gets back down to break even, you might just pull the plug on that, right? And after you see something like this was barely anything, right? This was a 6 tick breakout. Come on, give me a break. Right? But you're also looking at this. You got the trend here, right? Higher low, higher low, higher low, higher low. So it's looking good, and then you set your line right here. Okay, you're right on the other side. If it triggers you, then you're good. Okay, and you're also not looking for 5 ticks. You're looking for 4 ticks. Okay, or break even. Break even. Don't even take a loss on this stuff. Don't even take a loss. It's so slow. You really don't need to, and you don't need the money. Remember, 7 and 3. You don't have to don't have to push this, okay? But then it fails. So this turned out to be a real big dud, and you can tell how big of a dud here, based on the size of these breakouts. These are tiny little breakouts. They're just stupid, okay? And look at the volume. Actually, I don't think volume is going to help you out much here. Oh, and then here, look. You get your MACD, it's turning around, it's reversing. This is a double bottom right here. almost a triple bottom. I mean, if you count that right there. Um, so, but you know what? I'll tell you what. This kind of reversal and then a test like that, I would think that basically, this basically says that the bull here is very sleepy. Okay, a reversal like this, it ought to be going on up. Okay, so I was bullish, but I look back at this and I look and see how much time this took, how this kind of bent over the long haul and then came back down and tested this again. Right, same prices, got bid up again. The bull was not very strong here. I got to keep that in mind. Okay, and we saw that right here. These tiny little breakouts. There were enough people watching. They said, "Yeah, exactly what I was saying." Right, and then they found out that basically the bull is not strong here, so they just kind of left. That's what happened. They kind of left. And another thing you got to realize is that that was a lot of profit overnight. So the algorithms basically are going, okay, well, we're going to take profits up here too. So it's the bullish people down here. They read this chart. They saw that this was not really a great reversal. And then it was also profit takers from overnight. Because we got back up into this territory, right? This is where they were taking profits. Okay, so basically this thing was in a range. If you're a range trader, which I don't recommend as a combine taker with 3 contracts, but if you're a range trader, this would be kind of for you. So next market. Okay, wait. How many did we lose on that? I think we were even. Okay, so on this one, I was waiting for the thing to come down and then come back up and show me its cards there. So I didn't take that trade. Comes back over here, does this thing again. To be honest, okay, so this one trade right here, this trade right here, and this one I broke even on. Okay, so 2 trades there. No bad trades. Crappy market. Okay. Now the reason why I show you all this is basically so you can understand what's going on underneath, so you understand strategies, so you understand the principles of business. You're doing business with the market, by the way. And so you can understand the principles of risk and metrics, the different kinds of business metrics. It's kind of an arithmetic kind of process. But mostly so that when you're looking at these charts, you can see ahead of you. When you get out there on a car and you're driving around, you aren't blind, right? Now, look at it like this, okay? Let's look at this like driving a car, right? So the market opens up and the market's right here, right? Are you blind here? Are you really blind, right? So try to relate to the road and you're driving, right? And so you can't even see in front of the car. You can see behind the car. This is all behind the car, right? But to be honest with you, where were you just at? You were behind the car. That's where you were, not physically behind the car, but you and the car were back behind where you are now, right? And so based on where you were at, tells you everything you need to know about where you are headed and what you are going to do. You know the possibilities. There are only a finite number of possibilities on the road. Okay? And for every possibility, you are either prepared or you have strategies for each occurrence that possibly can happen. Okay? And eventually what happens in life is that it becomes so routine and it's such a finite process of limited possibilities that you can basically drive with one finger or 2 fingers and barely even pay attention. You can think about things, you can talk about things, it's all in the back of your head. I mean, really. And then even if things come up, right, some kind of things start happening in traffic, you still are quick enough with your strategies, your reflexes, that you can actually maneuver around the things and then carry on the conversation right after you're done. It's the same in trading. Okay, so when the market's right here, you have a plan, and I'm telling you exactly what can happen, why these things are happening, and then what you're going to do when those things happen. So you're already seeing what's going to happen. What are you looking for right here? Okay, we got a breakout. Let's see here. Be more concise. You got a breakout right here. So what are you doing? You got one trade right there, and then you're going to be looking for the thing to do what? Go up, and then what does it do after it goes up? It goes down. Okay, so it goes down, and then you're going to see, is it going to bounce on support? Is it going to turn around above support? Is it going to break through support? See, those are the three things that can happen, and that's exactly what you're looking for. Now you're going to mark your resistance. Now, why is this resistance and not this one? Okay, we're looking back in time, because the market is in a bull trend right here. Okay, and so where the market turns back around, that is the high. Okay, and therefore that's the resistance. This is a fake out, right? It's a breakout, fake out. The breakout failed. Okay, and then it came back down here. And what is this? This is a breakout as well through support. Okay, but then it failed. Okay, and then it tried to get back up here through resistance, and then that failed. Now this is the NASDAQ, mind you. Okay, and this stuff right here, this whole process right here, is a real pain. Look, first of all, the reversal is dead in the morning, but there's a giveaway here, right? Got long tail, long quick tail on the handle here. Oh, another one, right? So basically, what's that meaning? Basically, every time the price comes down here, basically the piranhas, the bull pike, just hit these lines. That's why it's all bone here, right? It's all skin. And so that's indicating that bears don't dare go down there. So that's what you're seeing. You got a little breakout here, and then you got a handle. Got another handle. Okay. So really, it's all classic here, right? You can say that this whole thing right here was the cup. Could say that, right? If this is routine for you, you're seeing this stuff very clearly. There's even a quick tail right there to tell you a little bit about it. Now, when it gets back up here, so you got that breakout right there, right? That was one trade. Okay, and then you're not going to short this. Let's just say that you're not going to short this. Why? Because this thing just reversed and it broke out to the upside, so you're not going to short this. We're only looking for breakouts to the upside until this thing shows us that it has reversed and it is turning bearish. Okay, which means that basically it's got to do a whole different thing in traffic, right? Traffic out here has to do a whole different thing before we get that idea. And we're not doing business based on that premise. So we're not going to short this. Even though it comes back through support here, we're not going to short it. Okay? All right. So what does it do? It comes through support. It gets ate up again. Didn't we expect that? Did we see these quick tails here? Oh, yeah. Right? Bulls are biting hard. So when the price came down here again, what do? Yeah. So they're stacking up. All right, so what are we doing here? We're looking for a breakout again. And if you bought it right here and it broke out here, you obviously got that trade. Okay. Personally, though, this already broke out. I'd be looking for the thing to break out over here. And this thing right here would have got me. Okay, so I would have lost that one. So now, look, I won a trade and I lost a trade. Okay, so let's mark that down. Okay, because that one would have got me, and that would have been frustrating because I got my handle here, But basically, somebody had a bunch of orders, and they knew what was happening right there, and that's when they hit. Okay, so but fortunately, I've made enough profit that I don't get hit that badly, and I keep, I'm quick to scratch. $50-$70 down per contract, I'm done. That thing's done. Turn it over, right? Basically, that's just the ball gets turned over in the game. It's the other team's side. This turn, and that's how it goes. I mean, the whole game is an offense. It's not all profits, right? Offense and profits, the same thing. It's also defense, right? It's also cutting costs, paying for costs, limiting risk, knowing when your risk is too high. No, knowing when to scratch a trade, right? So you're playing defense at that point, okay? That should be part of the fun. That's part of the fun. Okay? I don't know about anybody else on here, but I was raised to be kind of a regimental security kind of person, right? You secure your property, you secure your family, you secure your community, you secure your country. Okay? Could have been a policeman, could have been a soldier. I won't get into what I was in, but that is something that I was avidly interested in. Could have been a fireman, right? Those kinds of things, right? And I wound up getting into these kinds of things. Not necessarily those, but a lot of those kinds of security things. Why? Because I like playing the risk and being defensive. It's something that I was raised on, okay? And so it's something that I practiced in life. And, it's not all about all the good times. It's all about how you handled the bad times. What does the General Patton say? He says, I don't measure a man by how hard he fails or how badly he fails, but how high he bounces once he has failed, or how high he comes back from that failure. That's how I measure him. Why? Because Patton is all about defense, right? He's all about trying to get through gutsy situations, right? And so if you suck at failing and then coming back, then you kind of suck. If you are great and you turn a bad situation into a good situation, literally, right? So that the advantage that was gained by the adversary turned into a disadvantage. Wow, that's the best you can do. So that guy right there is the best kind, right? So that's what you've got to be, even in sports or whatever, and in business. You've got to be defensive as well. How do you turn a bad situation into a good situation? It can be done here. There are strategies, in fact, where you can turn all the bad situations into good situations. Okay, so, but we're just getting through the combine now. Okay, so the main thing is that you don't take big losses. Okay, keep your losses about the same as your profitable trades. Okay, so this one, yeah, that one got you. I mean, this would have got anybody. This probably got everybody. Okay. Don't feel like some dumb clucker out there, folks. If you get into a bad trade because you were doing it the right way, you weren't the only one. You weren't. Okay? The thing is, though, is how do you handle it? How do you come back from that? How do you handle that thing? Do you let the loss keep taking you and taking you and taking you? What if you hold on to this thing all the way down to here, right? Let it break through here and you're down to here. What do you do then? You just lost a whole ton of your trades. You probably lost like 2 or 3 of your trades already by the time you're down there. And then you pull the trigger and then the thing comes back. Now you feel really bad. Oh. Right. So you don't even want to be there, right? Just go along with everybody else and just cut the trade right about here. Okay? You lost 50 or 70 bucks on a trade. Big deal, right? The main thing is not to lose all of your good trades. Just make it one bad trade, not 3 bad trades or more, right? You've got to pass every single day. You got to put something away every single day so that you can pass the combine. Okay? That's the main thing. Doesn't matter how much, just something. You just don't want to go into debt, right? Don't go into debt. That's the main. That should trigger something in everybody. Debt, 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 right? Don't go into debt. Scratch that trade. Once it's 50, 70 bucks down, get out. It failed. It failed. It failed. Okay, the trade was bad. It was a bad investment. Sorry. It's not game over, though. All right, so now this becomes... I'm going to make this one resistance, and then we'll get a breakout here. Voila. Look how long that took. That took 5, 10, 15, 20 minutes. And that thing was already made back. Right? Dinner with sauce. There you go. And so the good trades continue to climb, and the bad trades never gained on you. Okay. It's all in one day, too. All right, so now you're up here, and you've got, basically, you got resistance again. Not really sure how this turned out. This could have this bar could have transitioned into this one, and then it tried to get over, or it went down and then went up and tried to break out, and then went down, transitioned over here, tried up, halfway up and failed, and then went back down here. I'm going to scratch that because I'm just going to say that I wouldn't even be involved in this. Remember, you are in a bull trend, and you are looking for one thing. Does the bull trend continue? Let's keep in mind my basic rule. 2 or 3 legs and you're done. Okay, and after you see these failures right here, okay, so basically these are not even touching resistance, which means that there's ticks in between there that couldn't even sell. That's rotting inventory. If you have long intentions, right, you got to get rid of those long intentions. Why? Because you got to sell it to the highest bidder as fast as possible, because you are going to start to look for bearish inventory. That's what you're doing at this point, right? Because you got quick wick. You've got space between resistance and the tops of these bars. Okay. You got this right here, right? Remember that fake out? This whole thing right there? That means that there's bears in the water. Okay. Somebody's taking profit or something. So we don't know. So this thing has to go through a whole evolution before you become bearish. Okay. Before you start shorting. Okay. Whole evolution. Okay. And, I mean, you can short right here. You can. Okay. But I'm going to tell you this. You can mess around with that, and you probably break even in the long run. Okay. You can break even in the long run. And, but the thing is, though, is let it have its say all the way through unto a reversal. And then you see, whether or not you're going to get in short. So obviously, if it's gone into reversal, then obviously you would be getting in short. Pretty easy. But the thing that does come down here, it makes the low here. Let's see here. Makes the low, and then it breaks through. So what I'm doing here is I'm seeing a low. This is how I'm driving. Okay, right? So basically we're right here and I can't see ahead. Like on a road, right? Okay. All I can see is behind me. I've got to base everything on behind me. Got to base all of that on what's going on in the future. Okay. And basically what I know. And basically what I know about what can happen and what I should or shouldn't do. Also, it is an hour and a half into the U.S. equities open. So we're getting to about that time of day. Okay. So basically we got this new low here. Okay, and then it comes down here and it breaks through. Now what I'm looking for is a breakthrough and then a retracement back up to here. Now does it retrace all the way back up to resistance? Does it leave some... Hold on. Does it leave some inventory? Right. Does it leave some rotting inventory there, you know, like the shopkeeper's curse, right? Rotting inventory. Oh, because that was money, right? You got to get your money back as much as possible, and then you got to get to something that's actually selling. What do people actually need, right? That's the whole game. That's the whole business. Okay, so then I gotta see the price breakdown, come back up here. If it turns around here, very bearish. That's very bearish. What does that mean? It's basically meaning the same thing as this over here. Those bull pike, well now it's bear pike because price didn't even get to come back all the way back up to here, which would have been resistance. Now we're not considering this stuff right here. Okay, so it didn't even get back all the way back up to where resistance was. Instead, bears bit the heck out of that and then it failed. Okay. Now that's hypothetically, right? But that's what I'm looking for. Does it do that, or does it make it all the way back up here and then fail, right? Which is not as bearish. But I'll tell you what, at about this time of day, which is 2 hours at this point, 2 hours right here, you know, the crowd is going to start to calm down. So I really need to see, you know, some real bearish indicators here. So some real red cards come out on the poker table before I start to get really bearish. Okay. If the thing comes back up to here and then it goes, I'm not real bearish. I'm telling you. So at that point, I'm not really interested in the market. Okay. Unless I see some real major indicators. Okay. Also, what did happen? This thing did fake out through support, right? And it was just all over the place here. This is really crazy right here. This will drive you crazy if you're trying to trade that. And it didn't even do what you got to do to reverse the market, okay? Which says that basically, oh, I don't know. I mean, basically it's like it is not in a bearish pattern. Okay, it means that there's bulls here, right? Because it was supposed to break down, but it didn't break down. So basically, it's a continuation of this. All right. Keep that in mind. Right? Draw that on there. Okay, that's got to tell you something. So basically, what it was we got a reversal here. It was bullish. Came up to here. Somebody started taking profits or something. It got a little bit screwy. They tested lower. It hit your trend line here. Okay, it didn't even break down below the VWAP, so that's pretty greedy. This is 34 EMA, by the way. And then it kind of continued up to here. Tested resistance. Came back down here. Whoop! What's that? Left a card on the table. That is bullpike right there, right? The fishing line comes down and boom, they hit the thing. So they're reeling the price back up. All right, so what does that mean? That you need to be, right, all these are bullish indicators right here, okay? So where do you got to be? You got to be somewhere out here, and there's a good trade right there. Now, how many bad trades did we make during this whole time? None. Why? Because this thing never reversed. I taught you everything you got to know. You can go back and review. There was no indication of a real reversal. You have to break support, and then you have to test resistance, and then continue on a bearish trend. That never happened. This thing ranged, and in some technical jargon, they can say that basically this thing flagged or pennant, made a pennant, that kind of thing. Okay, so it consolidated. right there. All right, that's all that was. Okay, and so basically, once you get all this message, right, the message, once you get all this message, then basically you're seeing that you're getting higher lows, higher low. What is this? This is basically a cup and handle. Okay, it's a little cup and handle. It's not a big deal. It's not a reversal cup and handle, basically. Okay, did test lower. The bulls did strike. Okay, you're already in bullish mode, so it's good for a trade. And at that point, it's 2.5 hours after the open of the equities. I'm not too interested. I am throwing it in, and also look at it like this. Right through here. Here was the open swing high. So 1 leg, 2 leg, 3 leg. That's it. That chart is done. Okay, that chart is done. Okay, no more on that chart for the day. Not until now. You can stick with it and you can see what it's going to do, and we can work this whole thing. What happens here? Well, basically you get into this time like everybody's on lunch and everything, so there's not a lot of participants in the market, so basically it's going to set up. Got a lot of profit takers. What happened here? Well, it looks like they tested there. This is exactly why I don't want to keep going, because the thing's going to start to reverse. Why? Because they made profits. Not only that, there are some bears here, right? So and then basically you've got support there. It breaks down through support. Okay, kind of bangs around there. Notice when it starts to get sloppy, right around the lines, it means that basically the volume's so low, and the algos are kind of they're basically like schizophrenic bus drivers, right? I mean, they're not trying to take you to your destination. They are trying to rip you off as fast as possible. So they're going to run out into like traffic, oncoming traffic. They're going to run out into the intersections while traffic is crossing. They're going to drive the bus off the bridges and stuff like that, okay? So that happens when the volume starts to decrease, and that's kind of what was going on here. And it looks like some of that right there, but the volume's still high at about that time. So what it's saying too is there's not a lot of uniformity in consent or consensus in the market, and basically when they start having to cross the lines a lot and then head fake a lot of head fakes like that, basically it means that there are a lot of emergency orders coming on. Otherwise, they would just let the thing do its thing. They would actually take advantage of all these things and go along with the flow. But when they start to contradict it during the high volume periods, or what I call the riot session, which is that first part of the in the morning, basically it means that there are some emergency orders stepping out in front, which is bad etiquette. So basically what happens when somebody is using bad etiquette? Probably they got emergencies, right? So that's how I take that and I listen to that. So it's kind of like reading a weather report, and I'm looking at the aggregate conditions, and I'm formulating a what's coming down the pipe or what's on the road ahead of us, not necessarily in the next hour, but in the next week or 2 weeks and then month. Okay. Well, then we're down here and we're back on the line. That's kind of tough to trade. We do have the lower high here, I guess. It breaks through, it breaks out of the range of the 34 EMA, so it's basically off the middle of the street, so it becomes tradable. I would say that once it came down here and it made this bull bar and it bounced right there, and then it broke out through there, that would be a good trade. Although it does look like it would have got me, because this would have triggered me in, and then this would have stopped me out right there. Okay, so this was actually a bad trade. And then I would be mad at that point. But you know what? I'll tell you what, though. This stuff right here, folks, okay, this whole area right here and this time of day, it's really sloppy. And you already saw it kind of playing sloppy that morning. So this whole area is really something that is bad news. Bad news, as in it's got holes in the boat, right? So it's just not going to hold up very well. But something that's going to really catch a trader's eye and bring traders in to help you push price in your direction, in a direction that you can read and you can trade, is this right here. Okay, so we got all this slop and we're testing lower again. What happened over here? Right, remember over here? Okay, we had that. Gotta switch my thing. Okay. Basically, so we had that test lower, right? Same thing here. Tested lower, and what happened? What do you know? They were right there, just like on the gold market, right? Boom, bull pike. Okay. What happens? The line's reeling back up with price on it. Okay. So then you've got the higher lows, got the case of the higher lows all the way up. But you know what? I'll tell you what. At this part of the day, I would only take the breakout of the cup and handle. So I see that. I see them right there. Same thing over here. I'm getting the message. There is a memo down here that says if price comes down here, we're taking it. Okay? That's exactly what that was. Just like on the gold market. Test a little bit lower. Leaves a little bit of another quick tail, if you want to consider that one right there, but it's definitely a higher low. That's money, right? Meaning that they left these ticks right here on the counter to rot. That's rotting inventory. So if you had any bearish inclinations, even just bearish inclinations, stock, right? Any kind of ideological stock, whether you're holding short or you're going to sell, okay, right? You don't want to sell lower, you want to sell higher, right? So if you know that this thing's going to reverse, you're going to wait for this thing to reverse and then sell up here or up here or something, right? Yeah, probably right here, okay? So however you hold stock in the downward direction or the selling direction or shorting direction or whatever, you got to take heed here. This stuff, this bearish stock did not sell. Right? It's rotting on the counter. So what happens? You got to get rid of that. You got to get rid of it to the highest bidder. All right? So you're going to throw that back out there, and you're going to take a little loss on that. And then you're going to start looking for longs. Okay. And then what happened here? Same thing. Even worse, right? That's a higher low. Okay? Higher low, higher low. Back down here, here's your cup and handle, right? The cup right here at the reversal point. The handle right there. Okay. Let's clarify this. There's your handle. There's your cup. And then the breakout. Okay. Now that's where I'd be trading. Okay. This is the most conservative trade there is. This is the most conservative trade there is. If this was the only trade, the reversal, the cup and handle, keep in mind that you've got MACD down here reversing too. Okay, it's flipping over. Notice. It's screeching back. It's almost about to flip over. This is the most ideal trade there is. You've got a cup, a handle, you got a quick tail, you got higher volume than what's normal. Now, don't consider all this. This is like the low volume part of the day, so consider all of the low volume bars from that time of day. You got high volume bar right there, heated pivot bar, right? Heated pivot volume bar, okay? And then you've got the, the complete cup and handle, and then you're about to break out. It's all there. It's all there. Oh, well, and also, you've got support down here. Right? Remember, they tested support. What's the memo down here? Right? Buy everything that they can when price gets down here. That literally is an algorithm that automatically does that. Okay? So I don't know how many institutions it is, but it could be one, and they're buying a ton, or it could be several. Who knows? But there's definitely a perfect trade right here. And if you just look for these, just for these, you would have basically a 9-to-1 trading, good trade to bad trade ratio. I promise you. The only problem is waiting around for those trades. Because they're not happening every time, right? There's like one every day, maybe two. And this happened to be one of those days where it was two. Okay? So, and then some days there ain't one, right? So, but you've got 5 markets, okay? If you're a combiner, you know the markets, okay? Which ones? So you got the breakout right here. There's the breakout of the cup, and would it go for another one? I would say 2. 2, definitely not 3. Not at this time of day. It's not a perfect day. It's not really strong. Okay, you got a lot of wackiness over here, right? They weren't playing by the rules. What happens when you come into a business and you're the investor and they're breaking the rules and they're costing and they're problems? What are you going to do to the boss? Are you going to compliment him and commend him? Are you going to commend the crew? What are you going to do? You're gonna draw the line. You're gonna say some stipulations. Hey, you guys are gonna be like this. I'm gonna reduce how much I'm investing. That's all there is to it. Well, the boss has a problem, and the workers, they got a problem too, because the boss has to make money and keep the business open, right? So he's got to get rid of workers. So, but the thing is, though, is that's real life. That's reality. And how is it based? It's based on debt. Okay. So all of this bad behavior says to the investor, I can't do this because this is dumb. I'm burning money, right? I got to have good order here, right? Without all this risk. Otherwise, nobody's getting paid, right? Shit rolls downhill, okay? And so consider that, and then consider how many legs that you can get out of this. Also consider how close you are to the close. Okay, so obviously you're close to the close. You're not in the riot session in the morning. You're in the evening, the afternoon. You're gonna give it 2. 2, and what if it doesn't even give you the second one, right? So then you gave this one back, right? So you got lucky here. That's 2 trades, 2 good trades. That there is the NASDAQ. Okay. And I am not going to give you the S&P 500 E-mini, okay? But basically, I look to the S&P 500 E-mini, okay, for reference. So as I would be trading that NASDAQ, I'm also looking over here on the S&P 500 E-mini. S&P 500 E-mini is a lot more stable. The movements are a lot more subtle. They're not as extreme as the NASDAQ. For every dollar that you can make on a, let's say that the equities market, these indexes, equities indexes, NASDAQ and S&P 500, they move from high to low, and they close at the low. Okay, so open at the high, close at the low. Okay, you will make $1.75 for every dollar you make on the S&P 500. So the NASDAQ index just makes that much more money. That's just how it is. It's not that there's actually more cash in the NASDAQ. A lot of the stocks that are in the NASDAQ are in the S&P 500. There are only 100 stocks in the NASDAQ. There are 500 stocks in the S&P 500. The NASDAQ's all technologies, okay, and the S&P 500 is just the biggest 500 American companies, okay. But as far as how much the price moves on the chart, that's what you're getting paid for. And it does so happen that the movements are much more exaggerated on the NASDAQ, which is something that I like. And I think it's a little bit more suited for the small time beginner in the trading biz, because the ticks are worth less. Okay, and that to me basically just is kind of like safety wheels when I'm trying to keep traders alive without blowing up their accounts. Um, so, but I do base a lot of my trades on the Nasdaq based on how the S&P 500 E-mini over here uh, is performing. I don't ever look to the SPX, to be honest. Um, I used to look to the tick, and the tick looks like this. So here it is. Okay, NYSE tick. And basically what the tick is, I don't know what it stands for. But basically what it is it's all of the stocks in the NYSE all added up together, and then their average gain or loss combined together, which is like 2,000 stocks or something like that. So it can give you an indication of bullish momentum or bearish momentum. Okay, I haven't used it in a long time. I used to use it. It kind of became a detriment where if you've got too much information from too many data sources, it'll screw up your mood. And I found it to become slightly unreliable, like some other indicators. And so I simplified everything. And basically, I learned to accept my losses. I learned what was most consistent, like this MACD. I've got two indicators here on top of each other. One is the 1513-1 MACD. That is not the original settings. That's special settings to keep the line singular, not double. Because the double line comes with a crossover. The crossover is obsolete information for me, so I keep it singular. The MACD histogram is what these bars are down here. Okay, volume. I look at volume. It's got to be green and red, and neutral color. It can't just be one uniform color. These things have to tell me something. I've got to have candlesticks because the wicks and the tails, the opens and the closes, it's got to be 5-minute chart. Can't be anything else. These are the things that have worked consistently the most out of all the things that I tested early on in my career. I also use a heat map, which is not the heat map like you would get on Think or Swim. It is this kind of heat map right here. This is basically a depth of market heat map. You know what the depth of market is, right? Depth of market is this thing right here, okay? The dome. Depth of market, right? So basically it's the book. What is the depth of market? Basically, see this? This is the depth right here. This is the depth. How many contracts are here on the books? How many contracts are here on the books, okay? Well, these numbers here translate over here into colors. Okay? And then, see, the thing is, as these things change, there's no recording here to tell me how did they change. Okay? See that 117 right there? Okay? Now, this is not the same. These are not the same market. This is oil. Let's take a look at oil then. All right. Let's see here. We're going to look at 49.75, and there are, look, see the lighter color there? Wow, that's almost like two different contracts. Hold on. 7. Well, that can't be realistic. See, there's 107 right there at 75. Basically, what it means is this. Here we go. Here's a good example right here. Look, 50, 49.99. You've got 197, 176. So basically, 197 is real bright white. 176 is almost as bright. And then you look down here at 49.75 right there. Not quite as bright as up here. Why? Because basically what this dome heat map does is it averages out all of these levels on the dome, right? There's 10 on each side, 10 on the bid, 10 on the offers. It averages them out, and the higher off of the average that level is as far as limit orders, the brighter the heat map will show. Okay, so 176, 198 is far off of the average, correct? 49.90 right there. See it? 49.90, 168. So you can see it kind of fluctuating between 160s, 170s. Notice that it's a little bit brighter right there, and then it's a little bit darker right there. Okay, so basically, all of these things indicate these things right here, and when they disappear on here, they've disappeared on here. And what you are looking for is when they disappear and why they disappear. So if price approaches these things and then they disappear, you want to know that. And I can teach about that later on. When price approaches down here and then they stay, you want to know that. Okay. But also, this kind of chart is not a 5-minute chart. It is basically, it's like a second chart, right? Basically, it's a second chart. So every one of these tiny little lines in here was a second. Okay. Then it moved down here to this tick, this price level, and then each one of those lines was a second. Right. So you're seeing exactly how long it was at that price level, and then you're seeing exactly what price level it went to. It's every single detail as far as price movement goes. Oh, and then these bubbles here, okay? Basically what they are is market orders, okay? So basically it means that they didn't wait for their limit orders to get hit. So basically normally they'll have limit orders here on the offer or on the bid, right? Then price comes down to them, then they get filled. But if they hit market, it means that they've got to pay more to hit the market, pretty much, because you actually save money in the long run when you've got your orders, your limit orders, when you're doing it by bid and you're doing it by ask price, okay, and then you're waiting for price to come up to get you. Now you get in order, right? So first come, first serve, okay. So if price gets up to you and then it leaves, but it helped some people, it filled some people's orders, but it didn't fill yours, it's because you were not first there. So you got to wait for it to come again. Now that everybody ahead of you is filled, now you're at the front of the line. So kind of think of it like that. But when you've got market orders like this, okay, it means that they're jumping over the market. They're not waiting. Okay, it means they're jumping over the market, which is aggressive. Okay. They're trying to fill orders, and it can indicate that there's an iceberg there, meaning that there's a big order or there are big orders to fill, and you're starting to see that you're getting into a price range where it's very concerning for whoever's trading. It can mean stuff like that, and so you would know that if price comes down to there, then they would start to fill a lot right there. And if price starts to go away from them, basically you're pretty much safe because they got big orders to fill, right? So if the price pulls back any, you're assured that they are going to start to fill on that pullback and then drive price forward in that direction for a couple of legs. So that could be a big trade. But you're not up to that level. You're just up to cat scratch. Small, private recruits, just small trades, not big trades like that. So someday you'll get that stuff, and I'll go through the whole series about all that stuff. And then last of all, these bubbles, these market orders, they are bigger for more orders that come across as market orders out here on the exchange rather than just ordinary, limit order trades. And then basically, the more blue they are on this thing, this particular one, this is Jigsaw Trading. Okay, the other brand is called Bookmap. Okay, this one's the cheaper one. So it's cheaper in the long run. Okay, but basically on this one it's red and blue, and the red means sell orders. So these were market sell orders. The blue one here means market buy orders. And then you see the ratio. So it was mostly red, very little blue, mostly blue here. Now these ones are not that big of a deal. Basically what I'm looking for is if the market is selling off and then it reverses, I'm looking at all those bubbles and I'm looking to see, are there a lot of big bubbles there? Was it really intense? And I mean really intense. This is very spacious and sparse. Okay, this is nothing like that. Okay, so there are tons of bubbles all the way down there, tons of market orders, and that kind of indicates to me that there's a lot of selling. I'm going to look at the color and I'm going to see if there's a lot of selling. Then when the market comes back up and it reverses up higher and then it comes back down, I'm going to look at how many buy bubbles are there at the top. Now that's going to indicate how much interest there is in pushing the market higher. So this is going to tell me a little bit about that whole plunge lower, the reverse, the test higher, and then if it's going to actually continue higher or is it going to continue lower. So if the low here is packed full of sell market orders, then by jum, it looks pretty bearish. And then the test higher was very, very light. Not a lot of aggression there at those tests higher. Then I'm looking for the thing to break through the low and then get another trade out of it, another leg out of it. But if they're not there, if they've disappeared into the lows, right? So you've got a really bearish day and making a new low and a new low and a new low, and then they're not there, it's indicating that the reversal is new. It's afoot. It's coming on, and then the test higher, you're going to see a lot of blue bubbles, a lot of blue market orders they're trying to get in. Okay, and then what you're going to see is basically higher lows, and higher lows on this thing. Now, how does that differ? Oh, you're also looking at some of these the heat maps, basically the where is the liquidity right now. Keep that word in your mind. So 111 right there is liquidity. Is it much more than everywhere else? No, because basically everything else is about averaged about 70. So 111 is not that far off of 70, but 199 and 171, that's more, right? So that's more liquidity. And how does it show up? Right here, like liquidity. So right here at these three price levels, there's a lot of liquidity combined, right? So if you're long, that's what you want. If you got a lot of contracts and you're long, you want to go hit that, right? Because they're going to actually buy it from you when you sell it. Therefore, you don't get so much slippage. And if there's a bunch of people like that, they'll be pushing the price up there for you. So that's something that you're looking for. But also, when those long holders, those are bulls, when they sell, they get up there to that liquidity, and then they sell, a lot of time price bounces off. And the reason why is because they all just took profits. Okay? And so there's basically, if there's no one else left to buy, everybody's bought and made profits, it's kind of hard to keep the thing pushing up. And if the market's overbought, then it's probably going to reverse, and that would be the end of the party. That happens a lot. But if the thing breaks through all of that liquidity, okay, and then it continues on, that's very bullish, right? And the same can be true if all of this happens on the down low, so that liquidity is on the bid side, okay, and the buyers are down here, right? And another thing about this is that they spoof, so that basically they'll try to show liquidity, and they'll scare the market. Remember that the computers and the people, they are sensitive to these pockets of liquidity. Okay, so so if I was buying, for instance, I would put spoofs up here and push the price down as much as possible. Okay, because I'm buying, so I'm trying to buy lower and lower and lower prices. Right, lower and lower and lower prices until it stops working, and then when price comes back up towards my liquidity, what do you think I want to do? I'm not selling, but that's what that spoof means. Is these are sell orders. These are my sell orders. So when price comes back up there, I'm going to go pull those off, right? Because I don't actually want to sell. Okay, and then when I pull that off, everybody goes, that was a spoof. We were getting higher low, higher low, higher low, and then we creeped all the way back up here. I think this is the bullish trade right here. So everybody buys right then, and what happens? They push you higher. Okay, and so then as they're buying, you're selling them some. Okay, so you're getting some profits at the same time. Now that could be your entire trade. You could be a long-term investor. So then as it legs up, you're selling them. And you're selling to them, and then you're making a profitable trade, but you're also accumulating at the same time, and that's a lot of what they do in those offices. Okay, this is a routine, over and over and over and over and over. Okay, so I basically just told you the gist of the entire story about the market and how you can read it all on these heat maps. Which is basically the dome, but in past tense and in color. Okay, because notice you don't see the past here. If the number changes, you got to remember where that liquidity was. Now the old time traders, this is all they had, so after years, they became very good at memorizing these things. Memorizing this. They have all this in their mind. But now, you don't have to. So basically, you can work multiple markets a lot earlier in your career because you've got the leverage of this kind of information, right? Access to information, access to data and technologies and that kind of thing is leverage, right? Why? Because it gets things done faster and cheaper. Well, if you were going to borrow a whole ton of money to get things done faster and cheaper, what is that money? It's called leverage, right? But all of a sudden you don't need as much money because the technology and the data is cheaper. Therefore, what is the technology and the data? It is leverage. So in terms of business, this is all adding to your profitability. Okay, so keep that stuff in mind, and then when you're analyzing markets and businesses and that kind of thing, okay, keep all of that stuff in mind, right? Even when you're investing in your property or budgeting your life out and that kind of thing, all these things come into play, right? The basic concepts. Okay, so where did we wind up? On 4 markets with 14 good trades and 4 bad trades. So let's go about roughly in the middle. We'll go 14 times 60, I guess, between 50 and 70, right? So 60 is between 50 and 70. And we'll go on average, I will say a modest 840. And then bad trades is 40. Let's go 70 because we did bad. Okay, 280. And 840 times 280, 560. 560. There you go. That's your day. And the thing is, if even if you got half of this, okay, it's good. You're good because basically, if you get half of this, 5 days, half of this for 5 days, you have passed the combine. Okay, like what is half of that? It's about $300 per day. Okay, after you've done that for 5 days, you've passed the combine. Then you're actually earning more than what the combine requires of you. And I'll tell you another thing. If you're doing 150, okay, now that sounds like a beginner to me, but that's good. Okay, to be honest with you, 150 a day is good. And 150, the combine is a minimum of 10 days. So times 150, there you go. See there? So 150 is like the bare minimum if you're trying to get through. Now you've got 30 days to get through the thing. Actually, you've got infinity. So it depends on what firm you're at, I guess. But the thing is, though, is that you kind of want days, you want bigger days, okay? So you got to cut your costs, got to cut your losses. That way your wins add up, okay? And that way, basically, you carry this to the next day, right? Carry this to the next day, okay? So that if you've got a bad day, okay, all this stuff makes up for it. So you're not starting over. The main thing in business is not to be starting over. Okay, so you're prepared. It's kind of like driving down a road. Okay, you don't want to be infirm starting over like you're a baby, right? So you try not to wreck. Okay, you don't want to damage your car, get into a wreck, and then get sued or anything like that. You don't want to lose the car. You don't want your insurance premiums to go up. You don't want a bad name, right? So it's kind of like business, right? You're trying to take care of all your risks and your costs. Okay, that's like 1 foot on the duck. This is something I talk about. 2 feet on the duck. If you got 2 feet, you can go where you want to go. If you're all offense and you're no defense, you're like a one-legged duck and you're just swimming round and around and around in a circle, and you can't help it. You just, every time you make something, you lose something. And then it's 1 step more, 2 steps back, 1 step more, 2 steps back, all round and around in a circle, right? Because you don't play defense. You don't take care of your costs. You don't limit your risks. You don't take precautions. You're not trying to get all the information that you can about a situation, right? You're not taking time to practice and think. You don't have a plan. You're not hedged or insured, right? Okay. So this is just the beginnings of that kind of lifestyle. You picked it. Okay. I'm telling you what it's about. All right. So good luck, and I will be on the next video.